Okay, credit risk. What is a credit risk? Credit risk is the risk that FI may not be receive the money back. Okay, may not be receive the money back in full. It is the risk when the FIs lend the money to the borrowers, but the borrowers are low quality borrowers. That is, they are very high. That is, those borrowers tend to have high probabilities of the default. Okay, those borrowers will have high default risk. So that's why the FIs cannot receive the money back in full. Okay, so I will read from the slide for this one. So for this one, you will see that if I make loans or buy bonds with a long maturity, and compare with the FI that makes loan or buy bond with a short-term maturity. The credit risk tend to be higher for the securities with the long maturities, okay? And the degrees of the credit risk will be lower for the short-term maturity securities. Why? Because if you hold a long-term maturity securities, you can see that we tend to have lots of unexpected situation during the time, right? Suppose that you hold only the 3-month treasury bill and your friends holds 10 years bond. Your life and your life and your friend life would be very different because your friend has to lock the money in the 10-year bond for 10 years. But you just lock the money in your 3-month securities for only 3 months. Okay. So for the long-term maturities, it is likely to have the higher degrees of the credit risk. Okay. Or you can imagine that you just lend the money to your friend for 10 years. It means that you just okay give the money to your friends today, and then you wait until 2030 to collect the money back. So your friend may go default maybe in year 5 or year 3, so you will be not receive the money in full. On the contrary, if you lend the money to your friends, let's say for 1 month, okay, for 1 month, your friends somehow can return, may return the money in full because 1 month is a very short term, and there is, I think, the chance of the unexpected risk is very lower for the short term transaction, okay, short term transaction or short term security. As a result of this, when you compare the depository institutions and the life insurer, you can see that the depository institution and the life insurers tend to be exposed to the credit risk than the money market mutual funds. Why? Because money market mutual funds invest their money in the money market, okay? And the securities that are traded in the money market are very short term, which is less than or equal to 1 year. Okay, so the money market mutual funds and properties casualties insurer tend to have lower credit risk for this transaction. Okay, um, one classic example of the credit risk is the subprime financial crisis. Dating back in 2004 to 2007, during that time, the banks tend, the banks, especially in the US, tend to lend the money to the subprime borrower. When we talk about subprime, when we talk about the borrower, sorry, when we say that these borrowers are prime borrowers, we mean that these borrowers will have high qualities or they can return the money in full. Okay, but when we talk about the subprime borrowers, we mean the borrowers with low qualities, so they cannot repay the money back in full. And during the time of the subprime financial crisis, let's say 2007, 2008, um, financial institutions recklessly lend the money to the subprime borrowers. And those subprime borrowers cannot repay the money back because the housing price goes down. At the time, the housing, the house the house is the collateral that the borrower used as a collateral for their transaction. So when the housing price goes down, the value of the collateral goes down, and this will cause the default. Okay, and because of these subprime borrowers are on the asset side of the financial institution, the value of the asset size of financial institution at the time would also goes down too. And as a result of it, we had the subprime financial crisis at the time because every transaction in the US, a large fraction of the transaction in the US depends only on the housing price. Okay, housing price, and we have the situation of the housing price bubbles, the speculation in the housing price market too at the time. So when the bubble bursts, this will directly affect the value of the balance sheet of the financial institutions. And this is also the result of the credit risk. Okay, the credit risk. Um, I think I would like you guys to read this slide by yourself, but I will explain it in words. It would be better for you. Okay, in order to solve the credit risk, the financial institutions can employ the screening to screen the qualities of the borrowers because the credit risk will directly affect the market values of the asset side. So that's why the financial institution need to screen the borrowers before let them the money. Okay. Um, this is the examples of the credit risk. I think we should see this graph. It would be give you some idea. Okay, let's see this graph. I just took it from Sauger. I think Sauger's is textbook. Okay, on the vertical axis. On the vertical axis is the net chart-off rate. Okay, the net chart-off rate, or the value that the financial institution write off from the balance sheet. Okay, so this one is the net chart-off rate. And here on a horizontal axis, these are years. Okay, so this is time series. This is time series. And you can see that we have three types of our transaction. The first one is about the consumer loans. The second one is the real estate loan. And the third one is the credit card loans. Credit card is the unsecured debt. Okay? So you can see that during the time here, 2006 and 2008, I think this is the onset of the subprime financial crisis. You can see that the net chart-off rate goes up. Okay, it goes up, especially the credit card loan. It means that the credit card holders cannot repay their debt. Okay, so that's why the net charge-off rate goes up. And we also have the same situation in both real estate and consumer loan too. But it would be very notable in the credit card. Okay, we call this the graph of the net charge-off. Okay, this one. And for this one, we also have the net chart-off on the vertical axis, and on your left hand side, and on your right hand side, this is the number of bankruptcy filings, and on the horizontal axis is the year. Okay, so this is also the time series, and from this graph, as you can see that the number of bankruptcy filings goes up, and it hit the new high, okay, during 2006. And during this time, you can see that the net chart of values somehow it goes down. But if you see, I don't know how to zoom it out. Okay. Okay, you can see somewhere here, 2002, you can see that the chart of rates goes up, right? It went up to this one. During the time 2002, this is the new high of the value of the net chart off. However, during 2006, even though we have the net chart off here, it came down somewhere here, but the number of the bankruptcy filings goes up, this one. Can you give me the reason why we have the structural break here? The structural break. Why we have the structural break in the number of bankruptcy filings in the US? Can you give me any idea? Any guess for this one? Because when you examine the time series, you can see that for this one, the graph would be pretty smooth, right? It's just okay to the upward trend. However, for this one, we have the structural break. Okay, the structural break. That is the graph change abruptly. The graph change abruptly. There might be some situation that affects the situation during 2006. Can you guess why the graph goes down to this one? Okay, thank you very much. Very good. Thank you. Thanks a lot. At the time, the U.S. government just implement the new law. So that law affects the number of the bankruptcy filings. Okay, so that's why it's just go down here. This one we have the laws announcements. So you can apply this to our context in Thailand. When you examine the time series data, if you see the structural change or the structural break in the graph, you may have to get back to the story behind that graph. And for this one, we have the new laws issued during the time. Okay? And you can see for this one, during 2008, 2010, this one we have the subprime financial crisis already. And you can see that this bar chart which represents the net chart of rate goes up and hit the new high. Okay, hit the new high, all-time high, somewhere here in 2010. Why net chart of rate hit the all-time high? It is because of credit risk. Credit risk. Because the borrowers cannot be paid the debt. So that's why. Can I go to the last one? Okay, this one. I will show you the example, this one to explain the graph. But I just skip a couple of slides to this one because I think it would be better to use this one to explain. You can see this one, suppose that this is the balance sheet that I will try to use it to explain about the chart of the chart of rate. You can see we have cash 20, we have gross loan 80, so in total we have 100. This one we have 90, we have equity 10. Now let's see. Suppose that we have 5 million as the default, sorry, we have 5 million as a non-performing loan. It is the amount that the financial institution cannot collect from their borrowers. So the commercial bank has to adjust this value from the value here. Okay. So this one you have the gross loans equal 80 million. When you know that you have 5 million as your non-performing loan, you need to update with these values. So loan after chart off is 75. Okay. So what is the net chart off? The net chart off is the value that you corrected from the value of the loan. Okay. So during the subprime financial crisis, the value that you have to adjust from the gross loans goes up because lots of borrowers cannot pay the money back. That's why the net charge-off here goes up. So the net charge-off here is the value that the bank just adjust from the balance sheet. And during this time, the bank need to adjust the last amount of value because borrowers cannot repay the debt. Okay, because this one 2008, this is the period of the subprime financial crisis. Okay, subprime financial crisis. Do you have any questions regarding this slide? Okay, if you have any questions, you can come to me after the class. Okay, I will read directly from the slide. Okay. FIs continue to willingly give loan because FI charge a rate of interest on a loan that compensates for the risk of the loan. For this one, you can see that when the financial institutions make loan to borrower, as I always mention about making loans, you will see that the FI need to evaluate the qualities of the borrower first. You can think about it as if you guys are bank managers, it means that you try to find the fair value of your loan. Okay, you try to find the fair value of the loan, and you will give the amount equal to the fair value to your borrowers. Okay, this is the meaning of the first sentence. So the important element in the credit risk management process is pricing. Pricing here means that you try to find the fair values of your borrower. Okay, you try to find the fair value of your borrowers. So the FIs or the financial institutions are the expert of this business because it can collect lots of information. It's high experts in the field to price or to conduct the pricing of the borrower, and it also has the policy on and the measure to monitor the borrower's activities over time. So that's why banks try to emphasize this kind of activities. Otherwise, bank will have the problem with the asset, okay, because of the credit risk. So this is the incentives of the bank. Bank try to survive from the credit risk associated to their activities. Bank cannot. Bank had to face the credit risk, even though they want or even though they want to or they don't want, because this kind of risk is in nature. So that's why bank cannot skip this kind of risk. They have to find a measure to overcome this risk instead. Okay, so I will not talk about this one. It is about the diversification. Diversification is something that you can use to manage the credit risk. It is that like you just put the money in the different type of your asset. So when one asset goes down, the value goes down, you will have other assets that still have the value. Okay. Firm specific and systematic credit risk. For this one, it is the results of the diversification. Diversification can reduce the firm specific credit risk. If you diversify enough, you can somehow lower the level of the specific credit risk. Okay, and even though if I can reduce the firm specific risk through the diversification, it cannot reduce what we call the systematic credit risk. Okay, because this factor is something that affects everyone in the system or in the economy globally. Okay, universally. Okay, if I still exposed to systematic risk. Okay, you will see that a good example of systematic credit risk is a COVID-19. You cannot reduce the COVID-19 because when it occurs in the economy, everyone's face the same situation. So that is the example of the systematic risk. Okay, finish about this one. The credit risk. Now let's move on to the next one. Why you think we still have 1 hour? Okay, you pay a lot of money in the class, so I will give you the high quality education as I can. If I cannot, I will find other people to teach you. Okay, let's see. Let's get back to okay, for this one, I will talk about the interest rate risk management. This is the most important one that I would like to emphasize. It can be your final exam, especially on your written exam. Okay, on the writing part, I think this one would be very interesting for that one. Okay, I will talk about this one carefully and give you lots of details as I can. Okay, let's see. As you know, the balance sheet of the financial institutions exposed to the maturity mismatch. Okay, exposed to the maturity mismatch. It is the difference of the maturity between the asset side and the liability side. Asset sides of the financial institutions tend to be the long term. Okay, tend to be the long term. However, on the liability side, it tend to be the short term. Okay, it tend to be the short term. So when we have the changes in the interest rate, or when the interest rate goes up, or when the interest rate goes down, this will directly affect the value of the asset and the value of the liability in different ways. Why different? Why different? Because we have long-term assets, right? So when interest rate change, it affects the long-term asset. However, we also have the short-term in liabilities. So when interest goes up, it also affects the value of the liability in somehow in different degrees compared with the asset side. Okay, so this one is really crucial because it is in natures of the banking management. You cannot eliminate this risk. You need to manage it on a daily basis. Okay. We use two methods, or we use two measures to measure or to calculate the interest rate risk. If you can calculate the risk in number, you can use that number and you can implement the policy to maybe to reduce that numbers, or you can use that numbers as a guide to diversify your asset. The first method that we will study is the repricing modules. But I would like to emphasize this one, the second one, which is quite popular among the practitioners, which is the duration module. Okay, duration modules. Okay, before I moving on to the methods, can I ask you a little bit about duration? Have you ever come across duration before this class? I think in the part that you study in the market for the debt security, I think you guys used to compute the duration, right? What is duration? Can I just ask? Have you ever heard about duration before? Sorry, have you ever heard about duration before this one? Before this class? Duration. What is duration? No worry, please. The reason why I asked you because I would like to check whether you know about this one before or not. Duration. Have you ever heard about it before?
Like the duration model or
duration? No, not word. I mean the duration model. I know that you guys know the definition of word. But here in this class, I mean the duration in the context of the financial market. I thinkอาจารย์ okay, I don't want to mention the name ofอาจารย์because I just record the video. When you study the topics of the market for debt security, you may have to study duration. Have you study duration in that topic when you calculate the interest rate risk associated with the bond? You guys know that when the interest rates go up, the bond price go down, right? You know this relationship, and can you calculate that relationship in number? Okay, I see. I know that. Okay. Before I talk about duration model, I'd like to get back. I want to step back a little bit. Could you please go to this one? Where is it now? Where is my cost? I cannot find it. You can find the supplemental section. I just upload the supplementary material in the morning to as the optional, but I think I have to use it. First, I will talk about how to calculate the duration, okay? And after finishing with the duration calculation, I will move to duration modules and the repricing modules. Otherwise, you will be confused. What is duration? Okay? Now, let's find our cost. We have lots of costs now. Okay, term 1. Okay, could you please scroll down to this one, supplementary material, how to calculate duration. You can skip this kind of slide because I use this lecture from other classes, so I would like to go to this one. Where is it? Restructure. Okay, this one, duration. Okay, let's talk about duration first. What is duration? Duration is a metric. It is a metric that we use to quantify the interest rate risk. Okay? You know that we have the negative relationship between the interest rate, right, and the value of your security. Duration will help you to calculate that kind of the relationship and translate that relationship into numerical value. Okay, so we will use this metric to quantify the interest rate risk. You can apply duration in the context of the bond market or in the context of the market for debt instruments. And we also use the duration in our context, which is the financial institution group. So duration is a metric or a measure that we use to quantify the interest rate risk or to measure the interest rate sensitivity. Okay, the interest sensitivity. Given the changes in the interest rate, the price sensitivity of a bond or the price sensitivity of any security can be directly measured by the duration. What is duration? Duration is the weighted average time to maturity on the financial security. I will explain this definition by the example. Okay, so let's move on to this one. Markovian duration. If you don't know about Markovian duration at this time, please no worry, just listen to me. Okay. Suppose that we have two options. Okay, we have two options. The first option is that we buy 1,000 coupon bond. This coupon bond has the face value set equal to 1,000. Okay, the face value equal 1,000. and we have 10% coupon rate. It means that at the end of the first period, you will receive 10% of the face value, which is 100. Okay, which is 100. Until for this one, we have 5 years maturity. So in year 5, you will also receive 100 as your coupon payment, and you will also receive 1,000. Okay, if you invest in the 1,000 coupon bond, it means that you purchase 1,000 coupon bond. And we also have option 2. Option 2 is a way that we use to replicate. It's a way that we use to replicate the structures of the payment of option 1. Let's see. For this one, we buy 1 year 0 coupon bond with 100 face value. It means that in year 1, you will receive 100. Okay? And next, you purchase 2 year 0 coupon bond. It means that in year 2, you will receive 100. You repeat these strategies until year 5. You purchase 5 year 0 coupon bond. And you also purchase 5 year 0 coupon bond with 1,000 face value. You can see that you can combine all of these purchase, and you will receive the same cash flows as option 1. Our assumption is that these two options are perfectly substitutes. Okay, it means that you will be indifferent between option 1 and option 2. Okay, because it can be substitutes. Okay, perfectly substitutes. Okay, 1 and 2. Now let's see what next. This is the idea that we will call the duration. Suppose that I just tabulate the option 2 for the first column or column A. Column A is the time to maturity. Okay, this is 1 year to maturity from the point from the current period. Okay, 1 year to maturity, 2 year to maturity, 3 year to maturity, 4, 5, 5. You can observe that for the year 5, we have 0 coupon bond with 100 face value, and we also have 1,000. Okay, coupon bond. Okay, 1,000. Sorry, 1,000 0 coupon bond. Okay, to give you the ideas of what happened, I would like to draw a timeline. Okay, you can see that we just repeat the same trick. Suppose that this is year 0, 1, 2, 3, 4, and 5. Okay, 1, 2, 3, 4, and 5. You purchase the 0 coupon bond, 100 0. Sorry, 100 discount bond. Sorry, I think it would be better discount bond. It means that you just purchase this bond with a value less than 100. Okay, but for this one, if it is a 1 year to maturity, it means that at the maturity you will receive 100. This is for the first discount bond. Okay, from the table. Okay, for the table, it is this one. Okay, for 1 year. Next, let's see. For this one, you purchase 2 year to maturity of the discount bond. Okay, in year 2, you will receive 100. you repeat the same trick. In year 3, you will receive 100, 100. But for this one, you will receive 100 and 1,000. Okay, 1,000. I think you guys familiar with this one, right? The timeline. It seems to me that you guys is a little bit confused about this one. So we just purchase a lot of the discount bond, okay, and we combine it together. We will receive the structures of the cash flow, like buying 1,000 coupon bond with 10% coupon rate. Okay, so this one I just calculate, and so if you get back to this table, okay, what next? This is the time to maturity. Okay. For the second column, it is the zero coupon bond. You will see that in year 1, you will receive 100, so on and so forth, to this one, 1,000. And for the column 3, we calculate the present value, okay, the present value of each cash flow. Okay, we just discount it back. For this one, we discount it back to year 1. For this one, this money occurs in year 2, right? You need to discount it back to year 1. And for this one, 1,000 is occurs in year 5. We just discount it back to year 1 too. So for this one, we discount is with the interest rate equal 20%. Okay, 20%. So this is the present value of each cash flow. Okay, this is the present value of each cash flow. When you sum everything here up, you will end up with 700.94. Okay, 700.94. This is the sum of our number here, or the sum of our present values. Okay, the sum of our present values. After that, we just use this 700 and we just divide 83.33 with 700.94. We also divide 69.44 with 700.94. We repeat the same tricks throughout of this present value. And what you will be receive is the numbers on your right hand side, which is in column D. Okay, in column D. In column D, I just multiply 100 with your result. Okay, let's see. For this one. Okay, I will, sorry. I think I should use the, well, okay. Okay, let's see. For this one, if you have 83.33 divided by 700.94, you will get 0.1189, right? Correct for this one? And for this one, if you can see in your table, this is multiplied by 100. Okay. The reason why I multiply it by 100 because I would like to present it in terms of percentage. If you sum up all of this value, it would be equal 100. Okay. So each one represents the fractions of each value associated with each maturity. So when we use this value, we will not use it in terms of the percentage, but we use it in a decimal term. Okay, for this one, we obtain it by use the value here multiplied by the maturity. The maturity here is equal to 1. Okay? And for the second one here, we multiply the time to maturity with this value. So what you will get is here 0.0991 multiplied by 2. This is the time to maturity, and this is the value that you will get. Okay, you just repeat the same trick to the rest, and this is what you will get. And if you sum up out of this value, you will get 3.99. This is called duration. So what is duration? Duration is the weighted average of the time to maturity. We compute the weight and we assign the weight to each maturity by the present value. We find the present value first, and then we just make the present value, we just translate the present value in terms of the weight. You can see that for this one, when we sum it up, you will end up with the 100 because each one is the fraction or the weight, okay, the weight associated to each time to maturity. After that, when you calculate duration, you multiply the time to maturity with this weight, okay, with this weight, and then you sum it up. What you will get is here, it is a duration. And we will use it as a metric to measure or to quantify the interest risk. If we have higher duration, it means that security with higher duration tend to expose to the interest rate risk. Okay, the higher riskier. Okay, the higher the riskier. Okay, the higher the riskier. So if you compute this one, suppose that you get the number maybe 5 compared with 4 or something, you will find that the security with the duration equal 5 is riskier compared to the another security. Okay, when we talk about risk in this situation, we mean the interest rate risk. So what is duration again? I would like to get back to the proper definition of it. The duration is the weighted average time to maturity. Okay, the weighted average time to maturity. You just assign the weight to the time to maturities of a series of the cash flow that generated from the securities, and then you will end up with only one single number. That one single number called the duration. Okay, and the unit of the duration is year. The unit of the duration is year. Okay, and we will take duration to our financial institution concept. In terms of economics, when we apply the ideas of the economics to the duration, you can think of duration as the elasticity. Okay, the elasticity. I think you guys may have a chance to study microeconomics, right? You need to practice. You need to compute the elasticity of demand or something. So the duration here in our context also reflects the elasticities, but it is not the elasticity of demand. It is the elasticity of the changes in the interest rate and the response of the price to that changes in the interest rate. Okay, I will talk about that concept in a few minutes. But at this point, I would like to make sure that you now understand that the duration is a metric that we use to quantify the interest rate risk. What is duration? Duration is the weighted average time to maturity. The weighted average time to maturities of the securities that reflect the sensitivities of the price to the changes in the interest rate. Okay, that is all about duration. That I think it would be sufficient for you guys to use it in our context in the financial institution. Okay, let's get back to our previous slide. Where is it now? Oops. Okay, now let's talk about the models that we use to measure the financial institution interest rate risk exposure. The first one is the repricing models. Okay, we use it. However, duration model tend to be popular, and it will give you the complete pictures of the risk exposure to the firms. Okay. But anyway, I will also give you the idea, the repricing model too. Okay, let's see. Um, suppose that it is a book value. Sorry. Suppose that we have a book values accounting cash flow analysis of interest income and interest expense over some particular period. Um, the repricing models will be calculated based on the book values of the accounting cash flow. Okay, we calculate it from the accounting cash flows, and we tend to emphasize the roles of the interest income and the interest expense. The most notable characteristics of the repricing models is that we divide we divide the asset or we divide the securities of our consideration according to the maturity. We have the 1 day, more than 6 months to 12 months. We have the more than 1 day to 3 days. All of these are the maturity bucket. Or we try to group the asset, or we try to group the securities according to their maturities. Okay, and then we calculate the cash flows from each securities. So when we use the repricing model, we have to calculate what we call the gap. The gap here is the difference between the rate sensitive asset or RSA and the rate sensitive liabilities. What are they? Asset and liabilities that are sensitive to the rate. It means that when interest rate changes, okay, when the interest rate changes, sometimes the effects of that changes will affect some asset, but it will not affect other asset. Okay, for the asset that are sensitive to the changes in the interest rate, we call it the rate sensitive asset. For those that are not sensitive to the changes in interest rates, we call it, I think, the fixed rate or something else. But anyway, I would like you guys to know that in the asset side, we have two types of the asset. The first one is the one that's sensitive to the changes in the interest rate. When you calculate the gap in the maturity bucket, you need to make sure that you can group the asset and group the liabilities according to the rate sensitivity. Okay, according to the rate sensitivity. But anyway, for this one, you may see examples of the calculation of the gap. But I will not emphasize this method because it just gives you some idea. But anyway, the duration model will give you a complete picture. So I will go to this one and in detail. Okay, this one is very crucial. Let's see. As you know, that the duration can be computed from this method. We call this method as the Markovian duration. The Markovian duration. So the duration is the weighted average of the time to maturity. You compute the weight from the present value of the cash flow. Okay, that is the Markovian duration. And when we talk about duration, especially the economic behind the duration, we can use this formula to explain. You can see that this formula looks very much alike the elasticity of demand, right? However, we have different variables. For the numerator, here we have the percentage change in the market value of a security. You can think about it as the price, okay, the percentage change in price of security divided by the denominator here is the changes in the interest rate. R here stand for interest rate. Delta R means changes in the interest rate. So we can see that delta R divided by 1 plus R. So this one you can think in terms of the percentage. D. Measure the relationship between this guy and this guy. You can see that if the interest rate goes up by 1%, if the interest rate goes up by 1%, we will have the negative relationship in price. That means the price will go down. Okay, the price will go down. So that's why we have the negative sign here because it reflects the negative relationship between changes in the interest rate and the changes in the price of the security. When we talk about the security here in our context, we mean the security on our asset side and the security on the liability side in the financial institution balance sheet. Okay? So for this one, I think you guys may see that we just represent our negative relationship from this equation. If we have longer d here, d stands for duration. If we have longer duration, the size of the duration is very large. You will see that the price tend to be very sensitive to changes in the interest rate. Because the interest rate changes only 1%, the price changes more, okay, more than 1%. Okay, change more than 1%. Okay, this is the economic meaning of the duration. For the next one, I think it would be better if I write it down and you follow my step of derivation. Okay, if you cannot follow or if you cannot catch what I try to derive, I will derive this line, this line, this line, this line, this line, and do this one. To this one, okay, to this one. But it would be better if you follow my writing better than listen from the presentation. Okay, now let's start. What I'm going to do is to derive the equation of the duration gap. Okay, what I try to do now is to derive the equation of the duration gap. Okay, let's see. This is all about finance. You will see that we use a lot of mathematical formula and economic altogether. Okay, let me find my note. Where is my note? Oops. Okay, now what I try to give you here is the derivation of the duration gap module. Okay, the duration gap module. Okay, let's see. In order to assess the overall interest rate risk associated with the balance sheet of the commercial bank, we need to use the duration gap. Okay, we need to use the duration gap. So before analyzing the duration gap, first thing first, we need to determine the duration of FI asset and liability portfolio first. Okay, We will calculate the durations of the asset and liability, but it is not a single asset or it is not a single liability. Here we mean the portfolios of the asset and the portfolio of the liabilities together. Okay. Now let's see. Suppose that we have a portfolio of asset. Okay, suppose that we have the portfolio of asset. We will have the here stand for duration, subscript A. A stand for assets. Okay, A stand for assets. This one equal. I will write it down first and then I will give you the explanation. But I want you guys to write it down too because it will give you the state of the derivation. Okay, let's see. DA here, you can see that we don't have the superscript, okay? It is just DA. DA is the duration of portfolio of asset. It is set to equal X1A. X1A is the weight assigned, okay, assigned to asset 1. In this portfolio, we have N asset, okay? In this portfolio, we have N asset. This is the duration of asset 1. This is the duration of asset 2, okay? This is the duration of asset N. And here is the weight assigned to the asset 1. This weight can be calculated from the total asset in the portfolio. Okay, we calculate the fraction of that asset and we assign that fraction into each duration of each asset in that portfolio. This is the weight of asset 1. Okay, this is also the weight or the proportion of the asset 2 in the portfolio. This is also the weight, okay, the weight of asset N in the portfolio with the duration equal to dA. Okay, and we sum all of them together. So this guy here is the duration of the portfolio of asset, the overall duration of the portfolio. Okay, this is for the asset side. Are you so far so good? So far so good. Okay, let's see. What is one? DL. Okay, DL. This is the durations, okay, of the liabilities. When I talk about the liabilities here, I mean the portfolios of liabilities. We apply the same logics as the asset, as in the asset. Okay, for this one, sorry. That is no. This one equal x 1L, okay, dl 1 plus x 2L dl 2 plus x n l dl n. We have n liability and x1L, x2L, xnL, here's our weights that we assign to each item of the liabilities in the portfolios, okay? So for this one, we have both the weighted average of the duration in the on the asset side, and here we have the weighted average of the duration on the liability side. Okay, so this one, this guy dA and this guy dL represent the overall durations of the asset portfolio in the FI's balance sheet. This one represents the durations of the liabilities in the portfolios of the FI's balance sheet. Okay, we have dA and dL. Can I ask you some question? Let's see this one. x1 j plus x2 j plus x3 j plus x n j. Can you guess here? If we sum all of them, what is this number? Okay, correct. Because these guys are weight. Okay, when you sum all of them, it should be 1. Otherwise, you miscalculation. Okay, it should be 1. And J here stands for asset and liability. Okay, stand for asset and liabilities. Okay, now we obtain DA and DL. Okay, I think I go to the equation. We have terminated that. Okay, I will start from the simplified versions of our balance sheet. Here we have the asset. We have the liability. Liability. We have the capital here, but this one I will use the word equity in congruent with the lecture note, lecture slide. Okay, this one is the equity. Okay, from the balance sheet, you guys know that asset equal liability plus equity. Okay, asset equal liability plus equity. Okay, now we will examine this equation in another version. Okay, and this is the version that we would like to examine. This triangle stands for the chain. Okay, the chain. So delta A is the changes in asset. Okay, delta L is the changes in liability. Delta delta E is the changes in the value of the net worth. If you study FN211, which is the mathematical finance and statistics, you will find that sometimes we can replace this delta with d, okay, dy by dx in calculus. This one can be used as the changes, but it is the infinitesimal change, which is very small changes, okay? So we can use d instead of delta. But in our case, we don't concern this calculus, we just use this version. It would be enough, okay, for us. So delta stands for change, okay? Delta stands for change. Now let's move on to the next equation. So I just flip the equation here, like this one, in this fashion. Delta A minus delta L. Changes in the net worth, okay, equal changes in the asset minus changes in the value of the liabilities, okay. So for this one, we will exploit the definition of the duration. Let's see. We have this one, DA. DA is the durations of the asset. We can calculate DA from this one, okay? From this one that I just showed you the derivation. So DA here equal minus percentage change of the value of the market value of the asset. So I will write it down like this. This is the percentage change. Okay, changes in the asset divided by the asset. So we divide these guys by the changes in the interest rates. Sometimes we call this the interest rate shock. The interest rate shock. Okay. We also apply the same fashion on the liability side. We also have here DL. Okay, DL now is equal minus sign. Okay, percentage change in liability. divided by interest rate shock. Okay, divided by interest rate shock. Now you guys are shocked, right? Okay, I see interest rate shock. And then you just flip this side to this one. This is finance, so you need to make yourself familiar with this kind of equation. Is it very easy? Okay. Now let's see next. This is the equation one. This is equation two. 5 minutes left. Okay. For the equation one, for the equation one, what we have here is this one. Percentage change of the asset equal minus DA multiplied by interest rate shock again. We also have from equation 2, okay, from equation 2, percentage change in liability equal minus DL multiplied by delta R over 1 plus R. They are pretty straightforward, okay? Obviously, I think you guys can read this step because it is just the basic algebra, okay? There's nothing complicated for this one. Now, you just plug equation 3 and equation 4. You plug equation 3 and equation 4 back to this equation. I will call it equation 0, okay? Equation 0. You plug here back to equation 0. What you get is here. This is very important. Okay, it's very important. Delta E equal delta A. Okay, delta A minus delta L, right? This is from equation 0. Delta E equal delta A minus delta L. And for this one, you know that delta A equal what? Is equal A multiplied by minus dA multiplied by delta R over 1 plus R minus delta L. Delta L here, delta L here equal L, right? Minus dL multiply delta R over 1 plus R. Okay, what next? We just rearrange this equation and you should get something that look like this. Okay, let's see. This should be equation 5. Delta E equal A. Okay, multiplied by minus dA. Okay, minus L multiply minus dL, and I just pull interest rate shock here to here. This is equation 6. So for this one, I think you guys can pull A out of this bracket, and what you get is here dA minus L over A multiplied by minus dL. This is A. This is interest rate shock. Okay, the last one. Minus dA plus L over A multiplied by dL. This is delta E. Okay, this is delta E. Okay, let's see. You can see that for this equation. On your left hand side, it is the change of the market value equity, okay, or the value of your net worth, okay, the changes of the value of your net worth, okay, because we have delta here, and this one E is the equity, okay. The unit of this variable is in dollar or in baht, not in percentage. because it is just the changes in the value of the equity. This one, the changes can be divided, it can be divided into three main components. This guy is the first component. We call it the duration gap. Okay, the duration gap. This guy is the second component. We call it the asset. This guy is the third. This guy is the third component. Do you believe in ghosts? This guy is the third component. It is the interest rate shock. Okay. How can we call this guy L over A? L is the liability, right? A is the asset. L over A represent, correct. It is a leverage ratio. So in order to make it compact and concise, I will write it down like this one. And let delta E here is the changes in the value of the equity equal the duration gap, which is this one, minus dA plus little k. Little k stands for the leverage ratio multiplied by dL, which is the duration of the portfolio of the liabilities. Multiplied by here A. A here is the asset value. This one multiplied by interest rate shock. Okay. Okay. This is our equation of the duration gap models. This is the first component. This is the second component. This is the third component. For the first component, it represents the mismatch between the asset side and the liability side. For the second component, it measures the size of the financial institution. The size of the financial institution. And for the third one, this one is the interest rate shock. It measures the amounts of the shock, okay, through the balance sheet of the commercial bank. Okay, I think I will finish the class by this equation. And before you guys, you know that for the next 2 weeks we don't have the class, and we don't have the class for the next 2 weeks, right? Or the next week, I'm not sure, because we're gonna have the rehearsals of ceremonies, award ceremony or something. So that's why we will have the makeup class on 15 September, I think. No, sorry, November, 15 November. Okay, sorry, 15 November. Okay, I want to show you this one. Some of your friends asked me about the financial crisis, the presentation. So I just give you the guideline, because we will have time for 2 weeks that you will not see me. So this is the idea of the presentation. Okay, this one for the semester. This presentation account for 10%. Okay, 10%. You will have a group presentation. Listen to me very carefully. I would like you guys to form a group, okay, with 4 to 5 people, 4 to 5 members in your group. Or would you like me to form the group for you? Okay. So you should form your group, let's say 4 to 5 members in the group, okay? 5 is the maximum, okay? 5 is the maximum. Each group will have to present, give the presentations of the financial crisis for 15 minutes. And after that, you will have the question and answers, Q&A session from the floor and from me, okay? And this is the details, okay? The details of the presentation. You will have to give the presentations with the PowerPoint, or you can do some video recording, or you can role play. It's up to you. And one thing that is the requirement, you have to come up with the executive report. Okay, the executive report shouldn't be more than 2 pages. Okay, 2 pages is the maximum. Don't do exceed 2 pages because I don't have time to read. Okay, this is executive summary. And please read about the plagiarism here carefully. Okay, because it will deduct from the point which you plagiarize from other people. And if you form the group, please just um, write everything down in the Excel. Okay, just put out the information in the Excel, such as group one, Mr. A, Mr. B, Mr. C, and then please send that Excel file to my email. Okay, to my email. What is my email? My email is, this is my name. One, okay, at gmail.com. We also have one here. So when you submitting your group list to me, I use the Excel to do the random number to generate the number to each group. So you will be assigned to each topic randomly based on the Excel simulation. I will give you the detail of that file when you send the group list to me. And these are tentative topics. Okay, these are tentative topics. If you have 10 groups, you will be assigned with some of these ones. Okay, so this one, the topic number 1, topic number 2 or 3, these numbers are assigned randomly from the Excel random generator. Okay, random generator. So everything is about luck. Okay, not predetermined. Okay, we still have time. Also, we don't have time. I suggest you guys to form the group now, and then please send everything to my emails. It should be by the end of it should be before the midnight, and then I will assign the topic, the number of the topic to you, and I announce everything on the Facebook group. Okay. Okay. Thank you very much. I'm sorry that because I just used the time. Okay. Thank you very much. Bye. ขอบคุณครับ